The unemployment-inflation trade-off is a cornerstone of central banking policy, rooted in the Phillips curve, a theory developed in the 1950s by Bill Phillips, which suggests an inverse relationship between unemployment and inflation, at least in the short run. What are the nuances of the theory? When unemployment is low, demand for labor increases, leading to wage growth. Higher wages can fuel consumer spending, pushing inflation higher. This implies a trade-off. Policies to reduce unemployment may increase inflation, while policies to curb inflation may suppress job growth and raise unemployment. Central banks like the US Federal Reserve, or Fed in short, operate under a dual mandate. On the one hand, price stability, maintaining inflation at the target rate, usually 2% for developed economies, and on the other hand, full employment, so striving for the lowest sustainable unemployment rate without causing excessive inflation. Accordingly, central banks aim to balance these two factors using tools such as interest rate adjustments and monetary policy to influence longer-term interest rates. How does this trade-off shape central banking policy? Let's walk through the scenarios, starting with the first one: low inflation and high unemployment. The objective is to stimulate the economic activity and reduce unemployment. How would the policy response look like? Lower interest rates to reduce borrowing costs and encourage spending and investment. Quantitative easing to inject liquidity into the financial system if required, as well as accommodative monetary policy aiming to boost job creation without triggering excessive inflation. For example, in the post-2008 financial crisis to around 2015, central banks kept interest rates near zero and implemented quantitative easing to reduce unemployment. However, despite aggressive monetary easing, inflation remained low due to weakened demand and deleveraging after the great financial crisis. The Phillips curve appeared flattened, even suggesting that low unemployment, as seen later in the 2010s, did not generate significant inflation. What about the next scenario? High inflation and low unemployment. The aim is to control inflation without severely harming the labor market. Suitable policy responses are raising interest rates to reduce spending and borrowing, cooling inflationary pressures, to reduce monetary stimulus, for example, tapering bond purchases or shrinking the central bank's balance sheet. The challenge is to avoid pushing the economy into a recession while combating inflation. For example, in 2022 to 2023, the inflation spike, the US Federal Reserve aggressively raised interest rates to combat inflation stemming from supply chain disruptions and strong labor demand. The US unemployment rate dropped to historic lows, so around 3.5% in 2022, but the inflation surged past 9%, forcing the Fed to hike interest rates aggressively. This period reignited debates whether the Phillips curve was regaining relevance after being considered quite weak in the prior decade. What is the third scenario? Stagflation, so high inflation and high unemployment. The objective is to manage a difficult environment with rising prices and weak job growth. Common policy responses are to focus on controlling inflation as the priority, even if unemployment rises in the short term. To address structural issues such as supply-side disruptions that exacerbate stagflation. For example, the 1970s stagflation, central banks struggled with soaring oil prices, which fueled inflation while economic growth stagnated. The Federal Reserve initially hesitated to raise rates aggressively, leading to prolonged inflationary pressures. Eventually, Fed Chair Paul Volcker implemented extreme rate hikes in the early 1980s, leading to a deep recession but successfully taming inflation. Let's emphasize briefly the role of the labor market in shaping inflation. What is the concept of wage price spiral? When unemployment is low, competition for workers increases wages. Higher wages raise production costs, which companies may pass on to consumers through higher prices, fueling inflation. Central banks monitor labor market tightness to predict inflationary pressures. What about the natural rate of unemployment, or so-called NAIRU? The non-accelerating inflation rate of unemployment is the unemployment level where inflation remains stable. If unemployment falls below NAIRU, inflation tends to rise as demand outpaces supply. And what about labor market slack? Central banks assess labor market slack, so basically unused labor capacity, to gauge how much employment can grow before causing inflation. To wrap up this section, the inflation labor market or unemployment trade-off is central to shaping monetary policies. Central banks must carefully evaluate the state of the labor market, inflationary pressures, and economic conditions to adjust their policies. While periods of low inflation and high employment represent ideal outcomes, real-world scenarios often involve trade-offs that require prioritizing one goal over the other.